Okay, so I just want to introduce Derrick. He's going to be doing our first part today. So Derrick Lasley is an insurance partner with Hart CPAs. He's been in public accounting industry for 12 years now. He specializes in employee benefit plan audits, so mainly doing 401k audits, health and welfare plans, and ESOPs. During his career, he's worked with plans of all sizes, from first-year audits, barely over that threshold of meeting one, up to plans with combined assets of over $1 billion throughout his career. He's worked on those. So currently, he leads Harris's internal employee benefit plan industry group, and he's our go-to resource for technical training for the audit team. So thank you, Derrick, for presenting today. And with that, I'll turn it over to you.
Okay, thanks, Tara. And yeah, so I'm going to just be focusing on the Form 5500 updates today, and then Ben Gibbons will be going through the Secure 2.0 Act update. You know, in recent years, there haven't been too many changes with Form 5500, but there were, sorry, I'm jumping ahead already. So there haven't been too many changes to Form 5500. I know over the last couple of years, there have been some changes on the audit side as far as the reporting requirements and things like that. And so the DOL had released some proposed revisions to the form a couple of years ago at this point, and the changes fell into 7 major categories. And so these changes are going to be effective coming up on January 1st, 2023, and will be incorporated to the 2023 Form 5500. So I know we already have a lot of, our 2022 benefit plan audits in progress. So these changes are more forward-looking. So, there's one significant change from these DOL updates that could potentially, reduce the plans needing audit. So, but that's going to be for 2023. So, not to, jump ahead, but if you have a plan that is still falling into that audit requirement for 2022, nothing's really changed. So this is just, looking at these prospective changes for Form 5500. And so of the 7 categories here on this first slide, first, which is the biggest one from my perspective, from the audit and accounting perspective. So there's a change in the participant counting methodology for determining the eligibility for simplified reporting alternatives for small plans. And I have several slides on this, so I'll go over that in a little more detail, but basically it's a change in if you qualify as a small plan or a large plan. And then for our practice, we have somewhere in the neighborhood of 50 benefit plan audits that we're performing. The majority of those are going to be your, I guess I want to call them generic 401k defined contribution benefit plan. And so with that, the second bullet point, there's also going to be some additional disclosure on Schedule H for administrative expenses of the plan. And so, these top 2 bullets, I have them, at the top because I think it's going to have the biggest impact on, the widest spread of plans. And then the rest of these changes, it's a little more, it's a little less frequent when it comes to these types of plans. And so this third one on the slide, a consolidated Form 55 or Form 5500 reporting option, and it creates this new concept of a DCG. And so, from what I've read, that it's going to consolidate multiple plans into one Form 5500, but from the audit perspective, it's still going to be that same kind of calculation on whether you're a large plan or a small plan, and individually those plans are going to require audit. So I'm interested to see more as far as who's going to be taking advantage of this DCG group. But I think for the most part, most companies are going to have one plan, and if it's a simple DC plan, that this first one is going to have the biggest potential impact. And then as far as the other proposed changes on the form, so there's going to be some improved reporting for multiple or pooled employer plans, so MEPs and PEPs. And again, these plans aren't, as frequent as, at least from what we see on the audit side. I think I have one map that I audit. So, not the most common of plans, but there's going to be some additional reporting required for those types of plans. And then again, improved financial and funding reporting for defined benefit plans. And these are, types of plans that, used to be more common, several years ago with defined benefit pension plans, but these are, really going away. And I think the most common trend is, seeing these plans be frozen and terminated. So not very common as well. I think, as a firm, we have one defined benefit plan that we still have at this point. So for those two, not the most common type of plans, but there's going to be some additional, reporting improvements for them. And then finally, there's going to be some new compliance questions from the IRC for plans, and then some technical and conforming changes when it comes to the annual rollover of these forms and the annual instructions. And so, those are the 7 categories of what the changes are going to be for the Form 5500. And so then I'm going to go a little bit more into the calculation for a large plan or a small plan. So this is historically what has been the determining factor for whether your plan was large or small. And it was based off the number of eligible participants at the beginning of the plan year. And it was 100 eligible participants at the beginning of the plan year. And with that, that would be anybody who is eligible, regardless of the fact that they're participating or terminated. And so there were certain plans that, might have fallen into that requirement that are around that 100 eligible participant mark. And so there was this rule that is called the AD 120 participant rule. And so this allowed plans that kind of fluctuated between 80 and 120 eligible participants at the beginning of the planned year to file their 5500 in the same category as the previous year, as long as they didn't go over 120. So if your company, you fluctuate between, 90 and 110 employees, that wouldn't necessarily have triggered an audit for you. It wasn't until you went over 121 eligible participants at the beginning of the plan year that you would have been required to have an audit. And so this visualization is kind of the best I've seen of this rule. So essentially, if you had less than 80 eligible participants at the beginning of your plan year, you would have filed as a small plan. So that's Form 5500 SF. And you would not have been required to attach audited financial statements to your plan, to your plan's filing. And so then, as you can see in the 80 to 99 category, or the 100 to 120, so if you filed as a small plan in the previous year, it allowed you to continue to file as a small plan until you got to over 120. And so essentially, this is what the rule has been over, currently in the last several years. And so with that change from the DOL on Form 5500, it redefines what is a large plan. So instead of using eligible participants, it's going to use the number of participants with an account balance on the first day of the planned year. So that could potentially, have a big effect for the number of plans that are going to require an annual audit. And so, as I mentioned, that goes into effect January 1st of 2023. So I know a lot of people are already in process for the 2022 plan audits. So you don't get to look at your participants and kind of rework and get out of the audit for 2022. So it's going to be based off of participants with an account balance at the beginning of the plan year. And so just to kind of visualize what that would mean. So showing under the old methodology and under the current methodology, what that would look like for a plan. So you're a small business with a 401k plan, you have 125 active and employed participants and 15 active participants with an account balance, and then 5 terminated participants with an account balance. So as you can see in the middle column, under the old methodology for your 5500, you would count 130 eligible participants at the beginning of the plan year, and that would require you to have an audit. And so in this plan situation, they only have 15 people participating in the plan. So the plan probably doesn't even have that much in assets, and the company's still having to pay that expense to go through an audit every year, even though only 15 people actually participate in the plan. And so under this new methodology, using participants within count balance, this plan would only count 20 participants at the beginning of the plan year in making that determination whether they need an audit or not. So they would no longer be required to have an audit. So with this, the DOL has put some estimates out there as far as how much this is going to affect small plans, and they're estimating almost 20,000 plans that currently file as a large plan will no longer be subject to the annual audit requirement because of this participant counting methodology change. And I think one of the numbers that I'd seen them throw out there as well is that it's going to be somewhere in the neighborhood of $100 million in audit fees for benefit plans for these small plans. And the idea with this from the DOL, it's to reduce that expense burden for these really small plans, and to also encourage small businesses to maintain or establish a 401k plan for their employees. And so, that's the largest change that's coming up for, at least from the audit perspective. So there's a lot of plans that, especially when you see companies that have low participation, they are no longer, going to need that audit requirement. And, from our perspective, we hate to, make them go through an audit for, just for the 5,500 to meet their compliance requirements, when it really is just, it seems like an unnecessary expense on the company. So I think that'll be a positive change for a lot of these small plans. And again, that's effective for 2023 plan years. So are there any questions on that? I mean, I think those can be added to the chat, and maybe we'll have some time at the end, but I think, it's a pretty straightforward change in that calculation for the number of participants. But, just wanted to, go through that, since potentially could be some positive news for some small plans out there in the future. And so with that, we're going to hand it over to Ben now for the update on Secure 2.0. And Ben is an associate with Holland and Hart, and he counsels employers on a broad range of qualified retirement plans, health and welfare plans, and other employee benefit arrangements, as well as executive compensation matters. And he's been a speaker for us for the last several years now at Harris when we do these summer sessions, and providing the legal and ERISA updates for our employee benefit plan audit clients. And so with that, I'll turn it over to Ben, so you can give us that update. Thanks.
Great. Thank you, Derek. And thanks everybody for joining today. Let me share my screen here. All right. Yes, as always, I like doing these for Harris. My past life, this is my second career. I was an employee benefit plan auditor for a little over a decade. So I was doing the same thing that Derek does, and that's good news. This change of participant counts for a lot of small plans is going to save a lot of audit fees that, like Derek said, probably aren't worth the money when you're only have a handful of participants that are actually in a plan. But nonetheless, we'll move on to Secure Act 2.0. This is also something that I'm kind of happy to be presenting on here. I did a lot of presentations over the last couple of years on what Secure Act 2.0 might look like. Originally, it was anticipated that some version of this would pass a couple of years ago, and then towards the end of every year, it was supposedly going to be included with some spending bill or budget bill, and it never was. And finally, my presentations kept getting longer because at one point there's 3 different bills out there that they finally distilled down into Secure 2.0, and enacted that at the end of last year. And these Secure 2.0 is a pretty sweeping piece of retirement plan legislation. There's nearly 100 provisions in here. And today we're mainly going to focus on, really are going to focus on provisions affecting defined contribution plans, so 401ks, a little 403b. We're not going to touch on anything with defined pension plans, defined benefit plans rather. There are some provisions there. There's a bunch of provisions dealing with IRAs. Again, we're not going to get into that today. All right, there we go. The way I've set this up is actually I've kind of followed the order of the provisions as they appear in the bill itself. And that's kind of broken up into 3 categories: contributions, kind of administrative items, and then distributions. So that's kind of the order we're going in. If it seems like an odd order, that's why I haven't reordered them yet based on logic, but this is how they appear anyways in the bill. And I'm going to kind of just give you a high-level summary of I think some of the provisions that I think are more relevant, especially to this audience and 401k plan sponsors. If anyone has any questions at any point, feel free to put it in the chat box, or if you have the ability to unmute, you're welcome to unmute and ask as well. But the first thing we're going to cover today is there's a new automatic enrollment requirement, and this is for new plans only. So presumably everybody here is a plan sponsor and already has a plan. But if you were to create a second plan, or if you find yourself with a new business in the future and you are going to implement a 401k plan, know that now you'll be required to offer automatic enrollment. All existing plans be grandfathered in, and like automatic enrollment now is an optional feature for your plans. Participants still can opt out. But again, this is going to be a new thing effective starting in 2025. There is a new safe harbor correction for automatic enrollment failures. So they're giving us some relief for those failures that are going to occur when they start requiring automatic enrollment of their plans. As of right now, hopefully most of you haven't had to deal with the IRS's correction program, the Employee Plans Compliance Resolution System, or EPCRS. That's an IRS program that gets updated from time to time, and there has been the last number of years now some provisions in there on how to correct auto enrollment failures when you fail to enroll someone timely. And the last couple kind of go rounds of that program, there's been correction provisions in there that were set to expire. Most recent ones expiring at the end of this year on how to correct those safe harbor, or sorry, those missed auto enrollment folks. And generally, if you correct them at a certain time, you don't actually have to make up any missed contributions other than potentially match, but no missed deferrals. That was set to expire, so this law has made that permanent. So now in all future versions of EPCRS, or the corrections program, we will know that you'll always be able to fix those automatic enrollment failures without having to submit employer contributions, or excuse me, employee contributions. This is a new provision that's kind of an interesting thing. So historically, there's been a tax credit for folks that have income below a certain level, which is relatively low. 41,000 for married filing jointly, 20,500 for single. What they are going to do now, instead of provide a tax credit for folks in those income brackets that participate in a 401k plan and make contributions, they're now going to, and this is effective in 2027, and I think they probably need all the time for this, and we'll see if it actually makes it to then. Instead of providing that tax credit when you file your tax return, the government is now going to make a matching contribution on behalf of those employees into your plans or your IRA, if that's where folks are contributing. How that's going to work with the government sending you a check to deposit in your plan, I don't know. Sounds like it's going to be an area that they probably will screw up, and I assume there'll be issues with it. But that is currently what the law is going to require starting in 2027. So again, we'll see how it shapes up. They certainly haven't issued any guidance on this yet, or really any guidance on most of these Secure 2.0 provisions so far. But this is an interesting one. So theoretically, if you have kind of employees in that lower income range that are contributing in your plan, then the government might be sending you money to deposit into your plan on their behalf. So interesting concept there. Increased catch-up contribution limits. I'm not sure is the reason why they've only allowed increased catch-up contributions over a 4-year period from age 60 through 63, but that's what they've done. So right now, the catch-up limit, if you're over age 50, you can contribute an additional $7,500, and that's indexed and it goes up every year. What they're saying, what's now going to go into effect starting in 2025 is that just if you're in the age 60 to 63 range, you can contribute additional catch-up, an amount that's going to be, the way the law is written, it's the greater of $10,000 or 150% of the regular catch-up amount. Well, 150% of the current catch-up amount already exceeds $10,000. So it's always going to be, unless the law changes, 150% going forward. So for that 4-year window, folks will be able to contribute additional 50% over that limit as catch-up contributions. So that's just going to help folks prepare for retirement as they're nearing retirement age. And this is something that is it's not really controversial. I don't think it's technically not required because plans aren't required to require catch-up contributions, required to offer catch-up contributions, but most plans, or pretty much every plan I think I've ever seen, does. And I don't think there's probably a lot of reasons why plan sponsors won't automatically increase or permit catch-ups to this new higher amount, but technically they don't need to. This is the big one here that's come out of Secure 2.0, and it's effective next year, so it's coming right up. And that is that next year, for folks that made more than $145,000 in the prior year, so in that case, I'm talking about 2023 earnings, they made more than 145 grand, then any catch-up contributions they make need to be treated as Roth contributions. And plans don't have a choice here. This is a required rule. So if a plan doesn't currently offer Roth contributions, and I realize most do, but some still don't, then they're going to need to add a Roth option in order to make those catch-up in order to comply with the catch-up contribution rules. This is causing a lot of stress to a lot of plan sponsors, and a lot of industry groups, retirement plan industry groups, are actively lobbying and petitioning the IRS and Congress to make changes and delay the implementation of this law. It takes a lot of work. If you have a plan that doesn't currently provide for Roth contributions to get everything set up at this point in just 6 months or less than 6 months till this is effective. So we'll see. I think that, and the IRS hasn't issued any guidance as to how this is going to work. If you're employed a partial year, do you prorate that 145,000? There's no guide. Again, there's no guidance on this. The expectation is that some of the first substantial guidance that the IRS issues on Secure 2.0 will be covering this. But the way things move in Congress, I'm not sure if the IRS has the power to delay this. I think it's probably going to take an amendment to Secure 2.0, and that remains to be seen whether something like that can happen. There's also a list of kind of technical cleanups that need to happen. When they made this provision, they accidentally eliminated the ability to make catch-up contributions technically under the tax code. So that needs to be fixed too. So it kind of remains to be seen what's going to happen here. But as of right now, be prepared that this is going to go live next year. And the one way around it, which is not participant favorable, is, and this is part of the concern, I think, in the industry, is that some employers will just simply not offer catch-up contributions because, as I just mentioned, they're optional. So that's the way to protect yourself if you don't want to add a Roth and you don't have Roth, is to eliminate catch-up contributions for next year. But again, not participant favorable. Now, this next provision is something that has there's a lot of buzz around student loans, certainly in the media, and the amount of debt that the younger generation in particular has. And it's made a lot of headlines a number of years ago. It's probably like at this point, 5 years ago. Abbott Labs, a pharmaceutical company, submitted a private letter ruling to the IRS, a request for a private letter ruling. It was granted, where they essentially devised a way to it wasn't technically a matching contribution, it was a profit sharing contribution, but only to those folks that made student loan repayments during their year or during that year. And the way that worked, they had an individually designed plan, and it was easier for them to make that happen. And kind of some plan sponsors tried to follow the technique based on this IRS private letter ruling. But it's not something that was written into pre-approved plan documents like most plan sponsors use. And as a result, there's been a lot of people have been clamoring to have a kind of similar provision that they can roll out that all plans could offer. So now we have this new optional provision that allows companies to make matching contributions on student loan repayments. So the student loan repayments, you could, contribute up to the 402G limit, which I believe is 22,500 this year. So if someone contributed that much in had that much in student loan repayments to make for the year, hopefully they don't, they'd get matched on that amount. And same as that limit would apply in the aggregate to both loan repayments and employee deferrals. But those matching contributions go in. You test the groups separately as far as EBP testing goes, and it's not required. The law essentially allows employers to let their employees self-certify that they made those loan repayments. At the same time, though, plan sponsors also have the ability to establish procedures, some level of procedures to essentially kind of audit those payments and require some level of substantiation. So plan sponsors could just leave it up to participants and say, we trust you. But I think more what I'm seeing so far, and I already have some clients that are working on implementing this next year when it becomes effective, is that a lot of record keepers are putting systems in place to monitor these loan repayments, because you don't want to just be giving away matching contributions if your employees aren't being truthful to you about making those student loan repayments. And this only applies to your kind of typical tuition and fees. It doesn't apply to any room and board expenses. We don't have, again, there's no guidance, additional color regulations on this yet, but the way it's drafted, it should pick up loans that, not only you have personally for your own student loans, but also if a participant took on student loans for one of their kids to go to school. The way the law is written, it would generally pick that up as well. So there's some flexibility there. But again, this is an optional provision. Plans don't need to do it. And I think some plan sponsors will probably wait until there's some additional guidance before rolling this out. There's this rule called the contingent benefit rule that essentially said the only contingent benefit that you as a plan sponsor can provide an employee to encourage them to participate in your 401k plan is a match. And that's the only thing you can give them, kind of quid pro quo for participation. To encourage savings rates, they got rid of this rule in Secure 2.0, and they now permit employers can now offer de minimis incentive for plan participation. So to the extent that you need to drum up participation because testing is not going well, employers can now offer. We don't know what de minimis is yet, but presumably $100 is probably de minimis, $50 probably certainly de minimis. Cash bonus, gift card, however you want to do it. But now that's one more carrot that you can try to entice participation with, and that's effective immediately. That was effective on enactment, so it can be done today. This next provision is kind of different. There's a similar provision that we'll talk about later too. A lot of what's happened here in Secure 2.0, as much as it is about kind of building retirement savings, there's a lot of provisions that kind of let you kind of take money out too. And this This, though, I have in the contribution section because it really is a contribution. Again, this is to encourage savings. And the fear is that some folks aren't saving in their 401k plans because they don't have enough money for emergency expenses when they arise. So what Secure Act did, and this is effective next year, and it's optional, is that plan sponsors can create these pension-linked emergency savings accounts in their plans where essentially employees can put in up to $2,500 in Roth deferrals. And it's not technically considered Roth, but it'll be after tax like Roth. So same idea. They can put in $2,500 of their deferrals for that year, and it counts towards the 402G limit. But that amount essentially can be segregated into this emergency savings account. And once it hits 2,500, it can't go past that other than earnings on those amounts. And employees are free to use that amount like a savings account. So if something comes up, they can pull money out. There's no withdrawal criteria at all. The only real requirements on the employer side is they can't limit, or they have to allow at least one distribution a month. So at a minimum, employees have at least 12 opportunities to take money out. Again, it remains to be seen how it's going to work administratively, but you could allow them to take money out all the time. And again, as long as they kind of direct more money into that, they can keep taking more money out. And I do have in here too, up in that first bullet point, that plan sponsors can automatically opt employees into this if they want at a 3% rate. Again, this is a new concept, so it remains to be seen what sort of appetite is out there for this, but just keep in mind that's something that you may be able to implement in the future if it makes sense. Here's another Roth contribution, and this one not required, but right now, this is effective immediately, and nobody's done it because no payroll system or record keeper has the infrastructure to handle it at the moment. But again, for whatever reason, they made it effective upon enactment of the act. Is that now the plan elects to offer it, employees can have their matching contributions treated as Roth. So employer would make the match. The tax withholding would come out of the employee's paycheck on it, and it would go in as Roth contributions and grow tax-free as Roth contributions do. So for folks that have plans where there's a high amount of Roth participation, this may be something that is worth exploring. But again, it's going to take a lot, I think, on payroll and the record keeping side to get this right, to be able to handle this. And there's certainly, I think, no rush to rule this out. I haven't heard of anybody that's planning on doing this for next year yet, and certainly nobody's done it in 2023. These next.
And I have a quick question on that section.
Yeah.
Let's see here. Just a clarification question on auto enrollment. So if an existing plan makes changes to matching contributions, does that impact the requirement for auto enrollment? Currently, this organization does not offer auto enrollment.
So for changing, if as long as the plan is currently in existence, it's not going to require any changes to the plan aren't going to require auto enrollment.
Perfect. Thank you.
Yep. Yeah, and I'm looking at that presenter view of the slideshow, so I'm not seeing. I don't see the Zoom window with the questions. So yeah, if anything else goes in the chat box, Jared, just let me know. All right. So on the administration side, this probably is less. I won't spend much time on this. This is probably less important to folks in this webinar today. I assume probably most of you are large plan, have large plan sponsors over 100 people because you presumably are an audit client, having your plans audited. But there's some additional increases. There are some increases in the startup cost credits that employers could have for starting a new plan. Those are now spread out over 6 years, and they start to phase out between 51 and 100 employees. Once you're over 100, you don't get any startup cost credits for putting a new plan into place. So again, know those are out there if you do end up at a small employer in the future. Another kind of small employer thing is that there's going to be this new starter 401k plan concept that is going to be effective next year. Again, I'm typically not working with small employers, so I don't know. Well, this one actually isn't even necessarily a small employer. There's no small employer requirement here, so you can do it no matter what size you are. But realistically speaking, it's probably geared towards smaller employers. And that is, you can put in this new plan in place that doesn't have a starter 401k plan, it's called. It doesn't have any compliance testing. And it can't put any employer contributions in, and it requires auto enrollment. But if you want to have this basic plan, which might benefit maybe a smaller business with an owner that wants to make as much employee contributions as they can, not have to worry about top heavy, that's where it might be interesting to some employers. But you can only put in $6,000 a year currently, and that's indexed. So again, I don't think this is going to be particularly appealing to most companies, but again, it's something that's available if there's concerns with passing testing, but no plans to actually make any matching contributions. There was a change in the long-time part-time employee rules, and for those of you who remember from Secure Act 1.0, they put into effect, and this is required for all plans. It's actually going to kick in 2024, this next year, that for employees that have that don't meet, so the plans typically can have service requirements of up to a year. That's usually 1,000 hours. And obviously you can have a more relaxed requirement. You could have no requirement for eligibility, but the most you can do is generally 1,000 hours of service. For employees that were part-time employees for a number of years that just weren't hitting 1,000 hours based on their part-time status, weren't allowed obviously into those plans. So what Secure Act 1.0 did was require that if you are a long-time part-time employee, so we're talking about employees that were employees for at least 3 consecutive years, and they had at least 500 hours in those years, then they would be allowed to participate in the plan. Now, they're only required to be able to make employee contributions, but plans could make matching contributions or profit sharing if they wanted to, but again, no requirement to do so. So again, that was measured over 3 years, and it's measured, it would have been 21, 22, and then this year is 23 is the last year. So for those folks that have big part-time employee workforces, that's going to go live starting 2024, and they're going to have to let those folks in that meet those requirements. Secure Act 2.0 decided that Congress decided 3 years was too long, and they reduced that 3-year requirement to 2. So starting in 2025, it's only going to be 2 years. So the 2025, that group that's first allowed in 2025, that's worked 500 hours for 2 consecutive years, that'll be measured based on 2024 and 2023 hours. And then obviously going forward, it'll be 2 years. So that's a change there. And it's something that, again, if the original long-term part-time employees, I think it is, I think pretty sure it's long-term part-time, not long-time part-time. So I think it's a typo on my part. That's why I keep pausing every time I say it. But long-term part-time employees, if you have a plan that's going to be subject, we're going to have a group of folks coming in, just make sure you're aware that this has changed starting next year. There's some new relief for overpayments. It's always been kind of a pain when you overpay a participant. A lot of times it tends to be small dollars, but historically, plan sponsors are required to ask for that back from participants, which of course rarely ever get. You'd have to usually send a notice to participants, letting them know that, hey, that distribution wasn't eligible for rollover, because usually a lot of times those funds roll over to an IRA or another sponsor's plan. So there was just kind of a lot of administrative work dealing with what were often small overpayments. So Secure Act 2.0 contained a new provision that allows plan fiduciaries discretion not to seek recovery of inadvertent overpayments. Now, if it's a huge amount, plan fiduciaries still might have an obligation to fund that money back in the plan, but they don't need to go after the participant for it. And I think even more welcome news is that any rollovers of inadvertent overpayments remain valid. So there's no more, telling somebody, hey, this wasn't valid, which then they have to go to their IRA custodian or their new employer and say this money wasn't valid, then that plan would have to kick it out and issue a 1099. All that's gone now. Now they can keep that money in the plan as long as there's an inadvertent overpayment, and that's effective immediately. So that's good news for plan sponsors. The required minimum distribution excise tax, was reduced for folks that fail to take timely required minimum distributions, which as of right now is when you hit age 72. That's when they first kick in. That has changed in future years. We'll talk about in a little bit. But before SCARE Act 2.0, there's a 50% excise tax. No one ever really paid it though. Usually if it was inadvertent, there was a form you could file to request relief, which was often granted by the IRS. Otherwise, plan sponsors could also do a voluntary correction program filing with the IRS to request a waiver of the excise tax. So you didn't see it assessed often, but in any event, and those ways to fix it still exist. But the way the law changed, now that 50% excise tax is now reduced to 25% if you fail to take those RMDs, and that drops to 10% if you correct it timely. So that's again, for those folks where it was kind of an intentional, they intentionally didn't take those RMDs, they've got some penalty relief that's effective immediately. I mentioned EPCRS, the IRS's corrections program. They expanded that to, there's certain, most 401k errors, most pension plan errors too, for that matter, to be self-corrected without having to do a filing with the IRS. They've expanded the ability to self-correct if you have an inadvertent qualification failure. Now, we don't know yet what that is because I haven't defined it. At some point, certainly I'm sure in the next year, there'll be a new version of EPCRS that has all this baked in, but know that in most cases now, we'll be able to self-correct, a lot more, just about everything, really. There's some things you can't, like egregious errors or any sort of fraud or misuse of assets, that sort of thing. And certain plan document, like amendment type, retroactive amendments, those sort of things, some of those still won't be able to be self-corrected, but most kind of operational failures will be eligible for self-correction. And one other thing that came out of this too is there's been a trend over the years to especially the last couple of years and the last couple of versions of this of EPCRS to permit self-correction of certain loan failures. At this point, SECURE Act has made it so just about every loan failure, for the most part, can be self-corrected, and that's welcome relief. 5 years ago or so, you couldn't really correct any loan failures yourself. Like even like a simple loan default required, if you were to correct it, not issue a 1099 for it, would have required a filing at the IRS. So they've made things a lot easier for plan sponsors there. All right. Oops. So I just got blocked by the pop-up window here. Again, probably not an issue for this group. Usually it's smaller employers that are concerned about top-heavy testing, but now you have the ability to split off a certain group of non-excludable employees, excludable employees, do a separate test for them. Again, if you do have, top-heavy issues, it's worth talking to your TPA about this. There's some welcome relief here as far as participant notices go. Historically, everyone was required, whether if you were eligible, to get kind of the whole barrage of participant notices that go out, some safe harbor notices, qualified default investment notices, SPDs, SMMs, all the various blackout notices, all the various notices that go out. They would go out to everybody, even if they weren't participating in the plan. This is no longer the rule. Starting this year, all it takes is to unenrolled eligible participants is just an annual reminder. Well, it takes giving them the SPD upon becoming eligible, but otherwise just an annual reminder of that they're eligible and when any necessary deadlines are for making an election. So that really is going to cut down the amount of notices. Now, right now, from what I've seen, plan sponsors, everyone's still doing, still giving everybody everything, and I think that's because that's how kind of record keeper systems are set up. So again, we'll see again, as they have time to tweak these systems, if we start seeing a reduction of those notices. But you certainly can provide more, but you're not required to anymore. Right now, again, it's really technically you're only required to provide that one notice reminding them, hey, you're eligible. Here's how to enroll. All right, and we'll talk about the distribution section. And this is, money coming out of plans. And in these distribution provisions, one of the big ones is required minimum distributions. Age increased to age 72 a few years ago from Secure Act 1.0. 2.0 increases that this year to age 73, and then 10 years from now, it's going up to 75. So good news for retirees that don't want to take money out of the plan yet. They can wait and further defer taxation. So before that, we talked about this pension-linked emergency savings account. This is different, but similar. It's an optional provision, and it allows plan sponsors to allow employees to take withdrawals for emergency expenses. And these withdrawals will be exempt from the 10% penalty, early withdrawal penalty. So if you're 59.5, you'd be fine anyways. But you'd be able to take a withdrawal. You still pay tax on it, and there's no criteria other than it needs to be unforeseeable or an immediate financial need relating to personal or family emergency. Completely self-certifiable, so employers that offer this don't need to request any sort of backup or substantiation. And participants who use that can take a distribution of up to $1,000 once per year. And they have the ability to repay those distributions and get the taxes back, but it's not quite as easy as that. And this concept of repaying these kind of new distribution types kind of first came into play with the CARES Act, coronavirus related distributions, which have since expired. But to actually avoid those taxes, if you repay it, that also requires filing an amended tax return for that year and requesting a refund that way. So it's certainly doable, but if it's a small amount, it might not be worth the added cost of amending your tax returns. This is welcome for plan sponsors that are trying to reduce headcount for cost purposes of their plan, or get under the audit requirement too, for that matter, especially now that account balances are all that matter for determining participant count going forward, as Derrick talked about. But the mandatory distribution limit is going to increase from 5,000 to 7,000. It's been 5,000 for I think almost 15 years or so, and it's going up to 7,000 now. That will require a plan amendment. And so this is something that'll be in all these pre-approved plans. And if you're banging in the background, I apologize. There's a window washer hanging on a rope, cleaning my window right now, just rappelled down. And so this goes in effect next year. And there's going to be, and I should mention this too, because I don't think I have this covered in a slide, is that anything that's required, a lot of these provisions are effective next year, 2025, but plan documents aren't actually required to be amended until the end of 2025, which is the same. Secure Act 1.0 is the same. They've actually delayed adoption of those amendments to the end of 2025 as well. Originally it was shorter, so I expect they probably will delay Secure Act 2.0 beyond 2025. But again, once we kind of cross those effective dates, plans still need to operate. The plans need to be operated in compliance with the rules, but the plan documents don't need to be caught up until, again, at this point, the end of 2025. And I suspect that, where most folks are on pre-approved plans, the document providers will be providing documents before that time, or at least some sort of kind of snap-on addendum that covers the new provisions. And this is something that I haven't seen anybody do it. This is in Secure Act 2.0, excuse me, Secure Act 1.0. Qualified birth or adoption distributions. It's optional provision where the participant can take distributions for any birth or adoption expenses up to $5,000. Again, you waive that early withdrawal penalty. The way Secure Act 1.0 is drafted, you could repay those at any time and kind of avoid the taxes like I talked about, which still require amending those tax returns. What they realized though is that after 3 years, you can't go back and amend your tax return, generally speaking. So they changed that. They've just changed that law here to require it to be repaid within 3 years. Again, I don't know if anybody has offers these distributions. I don't think it's been popular so far, and I haven't seen any plan sponsors that have done it. This is a big one, hardship self-certification. You know, maybe certainly 15, 20 years ago, plan sponsors had to generally, you know, request and keep hardship documentation as to the amount and the reason for employees' hardship withdrawal request. Over time, the IRS kind of eased up on that a little bit and allowed employers to employees to not provide the documentation, but just provide a brief, essentially a summary as to why and how much. And employers had to keep that in case they're audited. And Derrick might be able to speak this further. I don't know what the latest and greatest documentation is for plan audits here on hardships, but starting this year, only self-certification is the only requirement. So employees, says they have a hardship, employers got to allow it unless they know otherwise that the employee doesn't actually have that hardship, and there's no documentation the employer needs to keep. And theoretically, the employee would need to keep whatever documentation they have in case they're audited by the IRS, which is probably unlikely. But in any event, it's going to make things easier from an administrative perspective, not really having to track much as far as hardships go. Another optional distribution provision that is going to be available next year to plan sponsors for folks that are victims of domestic abuse. They will be able to take a distribution that again waives that 10% early withdrawal penalty, and again maybe be repaid in 3 years to recover any tax paid on the distribution. Also, self-certification remains. It'll be interesting to see how many plan sponsors offer this. I don't know, or how many participants also want to be interested in taking them up on this. I don't know. Maybe folks will be comfortable reporting this sort of thing to record keepers, but probably not directly to their employer. But in any event, it is a tool to help domestic violence victims if sponsors want to offer it. This is a welcome change. Is right now under the current law, required minimum distributions aren't required from Roth IRAs, but they were required for Roth amounts in 401k plans. Starting in 2024, no RMDs for Roth amounts in 401k plans. So you know, folks that pay their tax up front on those Roth contributions aren't going to be required to pull money out. And again, which makes sense certainly, and they're just really aligning these rules with the IRA rules. This is something that's not. This is something that's going to be technically required. Not sure yet though if it's actually a required amendment to plans, but if somebody's terminally ill and they provide certification, and again, not entirely clear yet if you're providing that certification, the IRS or the plan sponsor, then the 10% early withdrawal penalty, if they aren't 59 and a half yet, will be waived for any distributions they take from the plan. So it's not a special distribution. It's just any distribution they're already would otherwise be eligible to take under the plan. If they take it, they're terminally ill, and they get, you know, the physician approving it, then there's no early withdrawal penalty on that distribution. And this is another change to kind of bring some of the distribution rules in line with IRAs. Right now, under current IRA law, if somebody dies, the surviving spouse of that person can use their own. The required minimum distribution rules will run off that surviving spouse's age instead of the deceased IRA owners. And they are now extending this provision starting next year to 401k and 403b plans as well. So if somebody dies with an account balance, participant dies, their spouse gets the account, so they're the beneficiary. RMDs will run off that spouse's birth date and not the participant's birth date. And this, I think, this is my last provision here we're covering today. And this again has this similar concept where for federally declared disasters, you can take a distribution if you're affected by it, up to 22 grand. It's not clear yet though if that's lifetime or annual, but that'll be worked out in regulations. But again, no 10% early withdrawal penalty, be repaid to avoid the taxes. or again, at least, fix the tax. Obviously, your taxing is taken out. And this is something that the IRS had kind of been doing in Congress on an ad hoc basis after certain natural disasters. There have been a number of them for hurricanes and wildfires in recent years, where after the fact, they come out and say, oh, if you take a distribution from the plan, we're going to waive the withdrawal penalty. And it'll allow you to just, take that distribution out if you're, one of the people affected by a natural disaster. So now it's finally baked into the law. So it's going to be at any federally declared disaster. If you're in that disaster area and you're affected by it, you can take a distribution. Again, avoid those penalties that go with it. And again, this is going to be required too. It's not an optional provision, and it does create a new type of distribution. This is something that is technically retroactive effective date to cover some of the disasters that have occurred post-COVID, which was a federally declared disaster that they did not want picked up by this provision. That is all I have. We've covered, quite a bit, and that was most of. Again, I think what I think are the most important provisions and probably the most relevant provisions to people on this call in Secure Act 2.0. If anybody has any questions, feel free to ask. You're welcome to reach out to me anytime. If you just Google Ben Gibbons at Holland and Hart, I get all my contact information's up there. And that's all I have. Sarah?
Thank you so much, Ben. I don't see any other questions in the chat. Feel free to post those in there as I kind of wrap up here. But thank you so much for presenting today. Thank you, Derrick, too. I just want to remind everybody, we have a 2-part series this summer. So our next session is going to be August 3rd from 11 a.m. to 12 p.m. Mountain Time. We're going to go over fiduciary best practices. And we've invited Shane Hansen with Freedom Fiduciaries to lead that one for us. So you'll see an invite come out for that. But thank you again for everyone joining us today. And I will share this recording. We'll share the slides as well, if that's all right with you, Ben. And then if you guys have any questions, feel free to follow up. Thanks so much.